Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Wednesday, December 10th, 2025. It's 3:21 p.m. Eastern Time as I'm starting the video. I was watching the press conference from Powell after the Fed rate cut and shut it off. Let's see if I can get one out to you. It's going to be close, but nothing really super time sensitive, but I wanted to go over. I have a whole slew of trade ideas I want to update, highlight, and with the today being the Fed rate cut day, I just wanted to make clear what I've said dozens, if not hundreds, of times over the years that the initial move, or what I call the post-Fed noise. This is 2 p.m. right here. There's where you got the rate cut. Yeah, the initial pop. The initial pop was faded. I've often said I've never once, maybe I'm missing something, but going back decades, I cannot recall when the initial either drop or pop wasn't reversed, and that was the case there. And then even then, the subsequent move, which so far is up, can often be reversed. Again, it's not anything you can bank on, but I've never, ever once seen just a straight down that I can recall. Again, it's been a long time, or a straight up with the market ended up going that way. So my point is, as I've always said, and I will reiterate, if you guys recall, for those of you old enough to remember, there was a movie back in the late 80s, I think it was 1987, with Robert Downey Jr., James Spader. It was called Less Than Zero. I put a less than zero weighting, and I mean that, on any initial post-Fed move. So now that doesn't mean that we can't go build on it from here, or turn around and drop. It just means exactly what I said. I put less than zero weighting on anything because it's what I call post-FOMC noise. And so I shut the conference off. I usually like hearing what he said, but my God, he's, as I said back a couple years ago, he is the scorpion from, if you're familiar with the scorpion, the frog fable. You can look it up and you'll know this. He's a scorpion. He can't change his nature. So he's gone back to this. And as I watch him, I watch these reporters call him out continually on the fact that the Fed's nowhere near their inflation goal, yet the jobs market, according to most numbers, they claim is holding up. And so he's completely dismissive of it. He recognized that inflation is the biggest problem to the majority of Americans right now. Yet he's still doing his easy money thing to support the markets. But one thing I want to point out, and we're going to do that, we're going to roll into the equity markets first. Let me do it this way. Since it's going to be a long video, I'm going to talk fast. I'm going to try not to spend too much time on any one thing. Start out very briefly with the equity markets. There's no change today. We were negative earlier, slightly. We're slightly positive, so we'll call it a no change in the technicals, especially longer term. We'll go there. Then I want to hit on interest rates, primarily the bond markets, and commodities, talk about inflation briefly. And then I have a slew of trade ideas. I'm going to try to go through them in this order. So that way, if you're not interested in the broad markets, which again have gone nowhere for weeks now, individual stocks, I continue to say, are where the money is, both long and short. The market's stalling out. If you look at the momentum indicators and really where the S&P has gone in the last couple of months, which is almost nowhere, the money to be made is trading individual stocks. Tech's been correcting, other sectors have been going up. So I'll try to hit them in this order. I'll update NVO, that's Novo Nordisk, IRDM, REMX, CVNA, BIZD, PSP, MOH, TMUS, and Netflix, CCL, SFL, TPR, UNG, SIG, crypto. We'll look there real quickly. And then time permitting, the metals and the miners. So that's a lot of stuff. Let's dive right into it before we get away from the charts. This is just kind of this shows you the former leading index, which is kind of stalling out a little bit, not too bad, but still off the highs from back in October. So we are now about almost halfway through December, and we're still below the October highs. Remember, on the weekly charts, we printed those bearish engulfing candles. We had a sell signal here. We swung it down. This was 5 targets given to you. And it was 6 on the NASDAQ 100. We hit the last of those, reverse there. And so we've come full circle. Point is, just like the one of the reasons in the technical catalyst for getting short there, and the technical catalyst for the drop, I should say, the reasoning for getting short was the break of the bearish rising wedge there, just like we shorted this one too, covered it there, and or right a little below the bottom. We've come full circle, and I just want to reiterate that this is a divergent high. We have your indicators on this 15-minute. It's just an intraday chart making lower highs with prices making higher highs, as will for any time soon any marginal new high until and unless what happens is you can burn through divergence. That means if the prices keep going up and you take out these previous highs, you no longer have negative divergence. So, and I always say it's not a sell signal, it's a condition. So right now, if you look, there's a little minor trend line that broke down, back tested. It's really the same short-term setup I give you on, what was it, a 5-minute chart last week. We've gone sideways now for the last few weeks, really all months since the beginning of December. And we'll see where we go from here, guys. I don't have, like I said, I'm not reading in anything into today's move. I'm just reporting the status of the markets right now. This is a 60-minute chart. Also, that divergence on the 60-minute chart. And again, that was our divergent high, divergent low, divergent high. We'll see if it plays out or if it gets burned through. And again, I'll get back into it tomorrow once what I call the FOMC dust has settled. That's the post-FOMC noise. On a longer-term chart, again, nothing is going to change anytime soon unless we punch out to new highs. It'll most likely be a pattern, as I said, of the marginal new highs. It's been the pattern for as long as I can remember. Just like here, we put in the divergent high. We had a nice clean sell signal there, and the market broke down just like now, had a little drop, pushed back up, went on here to make a ever so slight marginal but still divergent high, put in a second bearish engulfing candle, and that did the trick. So history doesn't always repeat, but it often rhymes. We'll see. And, you know, that's almost too obvious from my experience. To get an almost identical setup is unlikely. That's all I can say because it's too recent. And so what then tends to happen is one of two things. What I prefer, you can fall reverse shy. And that would have to happen soon, as in probably down day tomorrow. And because all eyes are expecting they're going to try to trade and eke out that marginal new high. Or the other thing happens where you blow on through there and there's you know, pretty nice ramp up, and it's more than just a slight new high. Again, this is the way I'm leaning right now and have been. And as of now, those longer term sell signals are still very much intact, and we'll see where we go from there. Let me look at the smallies for you real quick. The smallies, meaning the Russell 2000 small cap index. Divergent high there. There was our sell signal in the break. We went down, put in a divergent low, and we hit that uptrend line off the lows right there. Remember, this is where when those targets on the NASDAQ that we traded, the QQQ and NQs were hit, that was support, our final targets, and we're covered and went long there. Personally, I didn't stay long the whole time. I started scaling back into small starter short positions, which I had. And as I've continued to maintain, I will not add to unless we get some evidence. I need to see the financials break down. They haven't taken out the 200s and the key support levels I've covered in recent videos. But from a bigger picture, that's what the small caps look like. So I'm using QQQ kind of as the large cap proxy. This is the biggest picture of the small caps. The weekly chart, you have this massive multi-year going all the way back to 2020, really, when we entered that range. There's the base of it there. And so we still have that triple top, effectively 3 equal highs. You know, this one's slightly higher. Just for inflation, you're going to get slightly higher prices, but still very much a divergent high. This divergence continues to build. So that's a picture of the kind of small cap from a longer term perspective. And again, on the short term chart, well, I'm using futures. That's what we're looking at there. So this marginal new high is still a divergent high, simply an extension of that previous one. We recently broke this little wedge, and now we are back testing. So if we get rejected, this is a level that needs to go to open the door to another bigger drop, and that's about 25.18. So that's your update on the equity markets. Let's roll into Let's talk interest rates real quick. So let me start with TYX. This is, to me, very, very important. Powell was called out on this, and it's just amazing how he's just dismissive on a lot of things. Some of the the reporters in there, the journalists called him out on the fact that pretty much without saying the words I've said, the Fed's lost control of the bond market. As I highlighted back here, we had a series of 3 back-to-back rate cuts, 3 consecutive meetings, and this has been well discussed since then. The interest rates, instead of long-term rates, this is a 30-year bond going down, they went nowhere but up. So the Fed said, ruh-roh, backed off. They go, something's wrong here. They thought that, whatever. And he tried to dismiss it today as being, what did he use? Residual inflationary forces or something along that line. Again, he's ignoring the other part of his dual mandate, which is good for the stock markets, good for equities. Except I'm noticing a pattern. You're pushing on a string. You're seeing diminishing returns from these rate cuts in the equity markets. But either way, this is the latest cycle of cuts. We just had our third in a row, just like back then. And as you can see, this is where we first, Powell or the Fed first cut rates. And instead of long-term rates going down, they went up. We had a second rate cut. They went up again. And the million-dollar question, ladies and gentlemen, what will they do from here? We just had to cut today. As I said recently, I'm not making a prediction. It's more of a watch level. I wouldn't be surprised if I had to bet, if you put a gun to my head, whether we pull back first. I think this level will get taken out, and that's where the market will start to say, wait, something's going on here. The Fed just hit their second round. That makes, cumulative. Remember, this is cumulative. Back here, you had 75 and actually 100 basis points. You have 175 or 1.75% cut in rates, and you can see long and short-term rates, of course, federal funds rate, long-term rates keep going up. So we just threaded the needle almost perfectly on that last TLT trade. You really can't do much better than that. That was based on the 60-minute chart. We shorted right here. We hit our final target here, and they bounced, to be expected. But again, if that trend line goes, or pretty much the recent lows, it's going to break out. Remember, TLT is the price. That's what we trade. We don't trade yield. We trade the bond itself, which moves inversely. So watch that level. It's a well-defined downtrend line. And price resistance above at about, 48.38. Very, very big level. It'll be technically significant if that happens, if we break out. TNX is the yield of the 10-year. I haven't added all the cuts. Of course, we had one here today. I stopped adding them here. But same thing, we had that flurry of 3 cuts. And you can see we're in this trading range right here. And we hit resistance. We hit the 200-day moving averages. So this is what Powell wants to see happen. This is the 10-year is what mortgages track more closely than the 30-year. And so whether it's this first and then that, or this happens soon, either way, I can tell you with a pretty high degree of confidence, I believe that will be a very significant technical event for both bonds, of course, and the stock market. Again, that's basically a break over today's highs in yield, which would be you go backwards, look at IEF, that's the 10-year, tracks the 10-year bond. So coming off that low right there, nice trend line, and that's it. So something to watch, whether or not you trade bonds. I don't get a lot of feedback. I know most of you don't trade bonds. I don't know whatever. People just like stocks. They think it's sexy, cool to trade, talk about NVIDIA, trade the stock market. I've always said, give me something with a ticker if I can chart it. I don't care if it's soybeans or Treasury bonds or Bitcoin or bring back the tulip bubble and that we had in Holland all those years ago, and I'll trade tulip futures if that's something I can chart and trade off of. So if you trade bonds, you just lever it up. You're going to get a lot more, a smaller percentage return, but you use much larger position size. And so then you're making the same or losing the same dollar amount you would on an equity trade if you adjust it properly, your position size. But again, even if you're not interested, which I know many aren't, watch these levels. They're important. So this is what Powell and the world wants to see and expects will happen. But again, by continuing to keep the easy money spigot on the short end of rates, you're keeping that inflation thing going. And then last but not least, as I said, this is one of my real-time inflation indicators, DJP. It's a broad-based commodity ETN, tracks the UBS Commodity Index Total Return. And there it is. So you can see, as I've told you many times over, this is where pretty much we had that abatement of inflation when they started raising rates to slow things down there. But then they returned back, like the scorpion did, back to his ways. He can't help it. That's who he is. It's ingrained in pretty much in every Fed member. You can see that, and this is what one of the journalists talked about is, yes, the rate of inflation has come down from where it was post-COVID, right? But the price levels, and that's what they remain elevated. Remember, the rate of inflation is the increase month over month or year over year of prices. So we had this huge surge in prices, and things abated a little bit, but now we're trending back up. And so again, this is very, very, in my opinion, extremely poor monetary policy. And in the longer term, it will matter. It will just roil the markets. Again, I'm talking long term, like I have been for, with the longer term outlook in the stock market, inflation, and interest rates. I do believe that I've made the case repeatedly that long term interest rates have ended a nearly 50-year secular bear market and embarked on a new secular bull market. So we'll look at rising rates most likely over the next decade plus, with the normal pullbacks along the way. All right, let's fire off trade ideas for those interested. Nova, the last update, somebody asked me about this, and I've covered it a few times. We bought this one. It was based on the weekly charts. This is the long-term charts here. Gave you on the weekly charts just two long-term swing trend trader targets. We hit the first target, pulled back, put in a marginal new and still divergent low. And then somebody asked just a couple weeks ago, I think it was on this day, and I said, yeah, I still very much like it, but only buy it, add to it above that 44.93 or call it 45 level. That was a one-day little, I believe that was a beautiful stop clearing move. Still have the same positive. Actually, we didn't even have on the daily, which we do now, as I said, at this new marginal, new low, positive AK bullish divergence. And so on the daily chart, as you recall, we hit the pretty much came up just a hair shy of that T5 target. But again, if we break out above the downtrend line, which I think ultimately we will, especially if the market holds up. Again, guys, you got to spread your bets. If you're putting everything right now in stock market, long or short, or NVIDIA or natural gas, you're going to be either very happy or very sad. Diversify, especially when the stock market is kind of stalling out here. Nobody's making money trading the S&P 500 unless you're a very active short-term trader. As I've mentioned recently, the stock market's going sideways lately. And so the money to be made are individual stocks, and that's it. So this one needs to get out of here. It's been basing right here. And again, I think a break of that downtrend line will take you up to that longer-term target I gave you on the weekly chart. This one I gave you the other day. It hit our second target today, Iridium. This one was highlighted in a video with a breakout to come above that trend line. So you're already good for, through today's highs, it's about a 17% gain. We're still up about 15. And I wanted to point out because we've cleared T2, we've taken it out. So I think I just highlighted it for you yesterday as an objective entry on the pullback close to T1. I said you don't want to wait to get all the way back to T1. It's too obvious. Maybe it gets there, but I like to buy a little, above in case the buyers step in early, which is exactly what they did. So you made a 10% in a day. And that's it. And I'm just going to maintain T3 as a final target for now. If you like it, this is a potential basing pattern. It could run back up to the 200s or more. And if that's your thing, just put a stop and let it ride. I think we could probably even put a trend line here. to raise stops now somewhere below that trend line, or maybe below T1, I think, because if you bought the breakout, T1's up here, your entry's here, you could have a stop somewhere down there. REMX. This one's on my radar for a short. We hit our final target here. Okay, so this one I gave you back is a setup on June 10th. Here's the post with an entry or buy signal to come above the intersecting, here, let me zoom in a little, above the intersecting downtrend line and that 430 resistance level. So that was your buy point. I gave you a total of 6 targets. If we took out this trend line, that says we're going to go up and hit these targets, and that was then. This is now. Right there was our entry point. We took out the 430 level, and we went on to hit all 1, 2, 3, then took out the trend line. You can see right there, the same trend line that I had. This is just a beautiful example of technical analysis, because once we took it out, we hit that fourth target, pulled back to the trend line, successfully back tested it, went up, hit T5, another reaction. Momentum fueled overshoot of my 6th and final target. That's good for, I think, an 88% gain, 100 if you took it to the top. I'm not saying that you would have, but if you did, that was a 100% move from our entry point. And now where I'm looking at it, that was a divergent high, and we had a healthy correction. You can see off that divergent high. But what I would like to see on this one would be one more thrust up like this to make a marginal new and still divergent high. Now I'm watching it. I may decide to add it back as a short trade if we break this uptrend line. But if the stock market can build on this rate cut and the breakout, make a marginal new high, we'll probably see one more thrust up there. That would extend the existing negative divergences, and it looks even better. You can see, I said, see weekly chart here. This is where we bought it on the breakout there, the downtrend line. This is long-term resistance right there with the next resistance level up here. So if we can push on and make a marginal new high anytime soon, we're going to have negative divergence. Just like we had here. That was a divergent high, and that was a divergent high. And we're going back at least a decade or more here, about a decade. And this guy is simple, this sector. Look for a divergent high, and you have a trend change. Once you get the sell signal, the trend line break, drops 75%. That was a divergent low, aka positive or bullish divergence. And, you would have had to get in on the 60-minute chart. I don't know if we traded it there. But that was a 422% run up to that divergent high. Trend line break, back test, marginal new high over that previous divergent high. And then the sector, this is a sector ETF, rare earth stocks, fell 74%. And then we came full circle. This is when we got bullish and long, bought it here, and that's it. So that's one is on my radar. Again, depending on what the market does, I may add it back add it as a short before then, but I prefer to see one last thrust up. All right, but it's closed out now from the previous trade. Final target hit, and the next one up is Carvana. I've given several updates on this recently, including the recent video. Nothing's changed on the weekly chart. Still a very big divergent high. It's still back testing. This is our yellow primary uptrend line off the lows right there. We recently broke down. We got a trade on it that hit the second price target right there and bounced. I'll get to that in a second. That's a daily chart. Marginal new and still divergent high in a back test. So as I've been saying, we hit this after hitting T2. So again, it's depending on how, that was a very high probability bounce target because you had the 200-day moving averages and the price target hit. So it's either profitable or unprofitable if you didn't take profits there. When it bounced after T2, before it hit our stop, I said next sell signal or short entry would be, or re-entry would be on a break of this uptrend line. Well, we kept going. We're still above it, and nothing has changed. When we break that trend line, this will now be, T1 will be right where I had that stop, which happened to be right around that high. That would be your first target. And then I think, again, depending on what the equity markets do, this is still very much a divergent high. We just don't have any sell signals, And because we hit the suggested maximum suggested stop, we're already out of that one. But I'm looking for a new trade, and we'll just once if and when this breaks and we fall back down below that T1, that's going to be a failed breakout to new highs. And for now, we'll just leave these additional targets. And I think I already gave you, yeah, I did. I gave you long-term trend targets here on the weekly chart, and those will come into play as well. Remember, this also on the weekly, we already hit T1 before. These are two different time frames, two different trades to two different type of traders. Active swing trader will use the daily charts, take profits. If you hit T1, you had an opportunity to cover and gain a 15% bounce, get short again, take it down, another 22% drop, cover there at 290 because that was a high probability target. Oops, I just moved it. I'll have to fix that. Either way, let me move on. So we're waiting for that trend line to break, and that still hasn't broken. That will be your next sell signal. BIZD. This one is I'm getting ready to potentially add this as a new another short trade. For those of you new to the site, long before they were in the headlines, I started zeroing in on this sector as a potential problem for the market. And this drop in the BDC, these are your business development companies, aka private credit. It's like private equity in reverse, the same kind of thing. These are a lot of private credit companies do private equity as well, but these are loans, that don't have the scrutiny of public debt. Publicly traded corporations have to really, every quarter open their books up to the whole world. Private credit and private equity, they don't. They can hide losses, a lot of blow ups, and we knew we had a couple already. Either way, so once we took out the level, we hit all four of my price targets, reversed on there. I gave it to you as a long trade. We hit the first of my three targets, but when we hit T2, I removed that final target, T3 right there, which I gave you, again, going long on the lows. And it's a good thing because we sidestepped almost the whole move up. It was a 6% drop, so we were able to sidestep that loss. Now we've come full circle. Even though that was my initial final target, it's now been hit, and it's still the same resistance level. So I think this one has probably run its course. At minimum, I think a pullback to back test this downtrend line right here. I'll stop somewhat above, but somewhat you have the 200-day moving average coming in ahead, and this is the next resistance level. So I think a stop somewhere in here. I think this sector is going to go down a lot lower ultimately. And I just toggled over to weekly chart. This is really nice support. This is where we hit. This is where we covered that short, went long. And now we've bounced up to that was initially my final target, which is also resistance about $15, right? And so my take is, again, it could have pushed a little higher up to those 200-day moving averages that are just above, or not. We're at price resistance. Going back down. If it gets anywhere near there again, we'll probably take out that. And then the markets are going to be, I believe, the equity markets and credit markets will be in distress mode. Risk off mode, and we'll go on down there. So I wanted to float that out there as a potential trade idea. Like I said, more of a soft than a hard entry. Sometimes I give you what I call a hard entry, meaning I take a full position because boom, it's a breakout. It's really nice, good entry point. Others, I give you kind of a zone. And lately, it's, there's the markets, the clarity on a lot of the charts are a little bit obscure. In a lot of cases, I'm doing this. I'm keeping things light. It's also December, guys. I told you normally I would take the rest of the month off unless there was something big in the charts that I saw. I do these videos. I get these trade ideas out to you, but I do share what I'm doing and what my thoughts are, and that is keep things light overall. And also, I would not have a full market short or market long positioning. I think market neutral or a blend of long and shorts. As I've been saying, you will vastly outperform, as the trade ideas on the site have, vastly outperform the equity markets by just going long the most bullish stocks, short the most bearish, or commodities, bonds, whatever else. Okay, next up, speaking of private equity, PSP is your private equity portfolio ETF. This one right here put in a divergent high, had a little drop. Certainly a nice healthy correction. Put in a equal but still divergent high. There's your negative divergence lines. Just like here, you had a high, a marginal new high, a lot like I think if the stock market happens to do that, it'll be the same, just like we have in the small caps, just like we had in the S&P 500 and NASDAQ 100 last year, or before, when was it last, before the last big drop. And that's it. So boom, boom, drop, boom, boom, drop. And if you look at this, let's turn off all these lines. We are now coming back. We've clearly taken out, we're dropped below the 200s. Here you drop below the 200s, you back tested them. You know, it's not unusual to go a little bit above and then dropped. So the big question is, will it regain the 200s? If so, that's bullish, or get rejected. Did the same thing here, took out the 200s, back tested them, and had another leg down. So either way, I'd like to see how the market acts post-Fed before taking a position in PSP. But I want to let you know it's on my radar. Probably get you a little minor uptrend line there. Needs to crack to do the trick, and a fallback below the 200s. Alrighty, what else? What else to have for you? MOH. This was also shared as a trade idea for you recently, with an entry to come on a break above 140, 150, 155, which we did. So I just wanted to say this one was also, I gave you a chart on the site. It's whatever. They're all under the long trade ideas. And we're coming up. There's an uptrend line. And now that we've taken out the 151 resistance, it would be prudent to have a stop somewhere in here. And again, there's your first, second, third target. So that's a fairly recent trade. I just shared that with you a couple weeks ago, I think. Let's see, what else do we have next? T-Mobile looks interesting. T-Mobile peaked back here, bearish rising wedge breakdown, secondary trend line breakdown, hit its primary uptrend line. Right here, lost the primary uptrend line and the 200-day moving averages. Little bear flagging action, took it down here, but now we're coming up on pretty decent support with positive divergence. So if you're looking for longs, this one's getting pretty oversold. Positive divergences, you can buy it here at 193, a little bit above there, you know, about to where we are, 193, 195, with a stop somewhat below. If it takes that out, you can see where my other levels are. But again, nothing goes down forever. If the stock market's going to go on to make new highs and anytime soon and rally into year end, then yeah, I think you're going to have the short covering rally in this one, bear market bounce, whatever you want to call it. Netflix I covered with you many times in the past. We had a bearish rising wedge breakdown there. Hit that first 114.70 support target, danced on it for months, a little sideways trading range. As I said, these things tend to act like energy building, like a coiled spring. When it broke down, it was a beautiful breakdown because it took out the primary bull market uptrend line, and then we went down my next support there, 107.67, did another trading range, which again we just broke down from, and hit that 95.16 target. And that's starting to go now. So this is ultimately where we go. And again, it's getting oversold. I wouldn't short it here, but this will be a great level to cover if you've been short Netflix. That's what it looks like on the weekly chart, bigger picture here. Took out that primary uptrend line right there. There's your bull market uptrend line off the 2022 lows. And again, I don't have a lot of support till we get to 82. And then ultimately, I think in the longer term, it goes down to about 69 right there. CCL is another trade idea I gave you. God, you'll have to reference it on the site. I don't have it pulled up right now, but I gave you 1, 2, 3, total 4 targets. I believe we shorted it somewhere not far off the highs, maybe on the breakdown here on that divergent high. What I wanted to update it because it's been dancing on its 200-day simple moving average right there. And once that clearly goes, that should take us down. We for all intents and purposes, you effectively hit T1. This is the first target zone. We came very close to it. But again, I still maintain those longer term targets. And I also gave you targets on the weekly chart that this was where we shorted it. Dual divergent high at dual resistance. You have the downtrend line resistance. We shorted it at the primary downtrend line and price resistance. And so this one on the weekly chart, if you're a swinger trend, long-term swinger trend trader, this is still how I see this one playing out. A lot of meat left on that bone. Just wanted to give you an update because I'm going through some of the trades I just haven't updated in a while that are still active trades on the site. SFL, still ready to pop. I gave you this one as a setup just in the last couple weeks. You have the 200-day, beautiful 200-day moving averages to define bull markets when you're above it like you were here. Once you take them out, night, goes the stock, and then you short rallies back to the 200s. And then if the 200s are regained, that's a breakout. So this one still needs to take out that 850 BOD, benefit of the doubt support, which is just above. Once that happens, you'll have taken out both the 200 simple, exponential, and price resistance. Big old gap right there. Should backfill the gap, hit my first, second, and then third targets. Most likely going to require the broad market to hold up or at least not go down too hard. So again, just an update there. That one's looking ripe, ready to break out. If the market can, or it can do its own thing. That's shipping. That sector sometimes marches to its own drumbeat. TPR, gave you this one here. I think we would have shorted, if I'm recalling right, the breakdown of that wedge. We hit my first target, hit my second target, which was beautiful support. It was both price support and the primary uptrend line and the 200-day simple and exponential. So that's triple support. And from that, you can almost bet the farm that you're going to get a nice reaction. That's what we did. So you had a chance to cover there. And the next sell signal is going to come. It's putting in an equal and still divergent high. No sell signal yet. Needs to break this trend line. That's why I wanted to highlight it for you, because I do believe that's coming. And the fact that we already checked T1, I'd have no desire to cover there. We've even hit T2. So if we take out the trend line, then you take out the 200 moving averages, you're going to go down to these next targets I gave you there. Total, if it breaks down soon, that's going to give you on the re-entry another 35% on that trade. In addition to the, again, I think we shorted right here. That first drop, we made about 17%. And that's TPR. UNG, pretty healthy correction so far, but right back to that T1. Told you I want to see it. That's the daily chart. Want to see it hold that. So far it's still holding, so that's an objective re-entry point. And I said I wanted, this is the 60-minute chart. You need to see it hold here as well. And I believe I mentioned as well, this is a level, T1 would be ideal to hold it here. But anything much below that 1345 level, that's where you might, again, depending on your entry, where you might want to stop out. Again, it's been a healthy reversal, but that's just the nature of this beast. That's why I call her the Widowmaker. And everything, again, guys, nothing has changed. The longer term outlook, I don't have my long-term weekly chart queued up here, but the fact this is where we pulled back to uptrend line support on that weekly chart, it's nothing but bullish so far. And the breakout, moving up, nothing goes straight up forever. Sometimes natural gas does get in that full throttle up mode, but quite often this is the nature of this beast. When you trade it, you have to know it, and that's a 21% pullback right there, followed by a turnaround and went up 27%, and then I have to move here to get the measurement, then dropped another 21%. So you see right now in the last few days we've only dropped 17. So these two drops again here and here in that uptrend, which we were long, caught that whole thing up, threaded the needle a few times in and out, long, short between, but that was where my final price target was hit after going long sometime off the lows here. So I just wanted to point that out for those of you either new to trading or new to trading commodities, but in particular natural gas. And years ago, I came up with what I call the know your security rule, kind of a play off the know your client rule. When I'm back to my days as a former stockbroker, financial advisor, they had that thing called your know your client rule. You could not make a recommendation without doing a thorough profile on them and understanding what their objectives are, their risk tolerance, where their assets are, how much they have, and what they're currently invested in. Until you had all that information, you couldn't make a recommendation that was appropriate. And I take that know your client rule and just say know your security rule. If you're going to trade natural gas, you need to know the nature of this beast and that's what she tends to do. And so if things go as planned, next stop, and then these two. All right. Again, on my eclectic mix of trade updates, Signet Jewelers, forget where, somewhere in here we would have shorted either the breakdown or the back test. We hit my first target, also slightly undercut the 200-day moving average. It's bouncing now. Once this bounce runs its course, this is a nice divergent high, just like that one there was. We're coming up to resistance. We have a resistance zone here that would provide an objective entry or re-entry for those that book profits at T1 or the 200-day. And I still maintain these two targets, and will most likely, make these official if we get down there, because then we'll have taken out the 200-day moving averages, which you can see that's what we did right here, and then all that followed. We took them out right here as well, and you had another big drop. So we need to, traders are going to buy these, both man and machine alike. It's almost a reflexive response. When you're above the 200s, you have pullbacks to the 200s in a bull trend. They buy them. You get the next leg up. Maybe that's what this is, but if they get taken out, then it's going to open the door to these deeper targets. Crypto. Let's do IBIT. As you know, this one was, we took it right at the lows the day of, milked it up to T2, hit that quickly. I told you I pulled T3. I had a final target there, which coin toss. Look, if the market's going to go to new highs, then we'll probably hit that because it'll be risk on return. But that's not my primary view. I told you I believe that we have another leg coming down, and Bitcoin is what I favor. On this, you can see right here, IBIT. If so, from where we exited T2, that's going to be another 20% drop, and possibly more. You can look at GBTC, which has been trading longer, to kind of see the support levels there. And that would correlate to about 52. Either way, this was just a big divergent high. And just again, based on my read on the charts, I don't think the drop is over. As I told you at the time, I was only looking to play a bear market rally, and I believe that's all that is. If it goes up a little higher, yeah, you've got the 200 days, which it lost right here. Maybe it wants to back test those. Again, that would be close to that IBIT T3. And remember, my trading plan does not have to be and is not your trading plan. I share my trade ideas. I share what I see. You guys decide. So some of you might be targeting T3, and if you are, remember you have the 200-day moving averages and really nice price resistance there. And so at that point, consider taking profits or at least raising your stops if you did take it here. Otherwise, this is still my preferred scenario, but most likely that's going to entail the stock market stalling out soon and not doing on either the NASDAQ 100, which is really the king of risk on indexes, either not making a new high or making a marginal new high and then failing, and doing so pretty soon, by sometime in January, no later. All right, what else do we have here? Look, all my crypto proxies go along with. I already said that. We did the day we went long Bitcoin, we went long Riot. Hit my T2 was the final target there at a potential that was hit, and so far you sidestepped the give back. And like I said, if you believe it's going to go up, and like I said, I don't have strong convictions. It was a 13% drop right back to T1. And so you can, again, I always said, trade these charts as you see, fit. If you exited there, turned around and shorted the pullback, you made, what did you make on it? I think it was 34% up to there. You turned around, you made another 13. You could re-enter long if you're still bullish and think we're going to go up to my third target, right? That's swing trading. But again, my confidence isn't very high right now on it. If I had to bet, I would say that's it, and we're going to go down and have another leg down. Because if crypto falls, if Bitcoin falls, we're going to get another leg down. That's going to bring Riot back down here, meaning from my second target, it will drop another 34%. And all right, same on the rest of them, guys. If you want updates, let me know. But that was it. Coin hit T1, Mara hit T1, Hive hit T1. Again, like I said, if I didn't think there's going to be, I didn't think it was worth it staying long. And I might change my mind on that and get back into these guys. But like I said, I felt better taking the quick profits. And then MicroStrategy is still, and this would mesh too with Bitcoin going down more. This is the closest direct, this is still what I call a Bitcoin proxy. It's not Bitcoin, but it's a company that holds Bitcoin. So obviously, but they also have a lot of debt. It's a leveraged play on it. And so you can see it's stalling out here, bear flagging, and I still maintain this third target zone. And that would mesh with another leg down in Bitcoin. And on that, it reminds me of the little Trump Boys venture, which I highlighted the other day. What was that one? ABTC. I forget which one's Donnie Trump Jr. or Eric or I don't know which. Two of the Trump boys are started this one, and I was blown away when I read about, as I told you the other day, they like MicroStrategy, except MicroStrategy has the net asset value, the amount of Bitcoin they have is much closer matches its market cap, even though there's a lot of debt there, which can and I believe will be a problem with MicroStrategy. But this one was insanely overvalued, unless I missed something, because the value of their Bitcoin holdings dwarfed their market cap. And so when I mentioned that bounced, when Bitcoin bounced, it hit this 187 target, and when Bitcoin bounced, it bounced up to that 263, and it's right back down. Look at that, already dropped 30% since that bounce. That was from the big drop was from the lockup, from the initial early investors, their share lockup. They were allowed to start selling, and boy, they have been, and the market's been selling it too. So this one just probably goes away one day, is my opinion. Worthless. But until then, all I want to tell you, it's that support. If you happen to fade that pop back into 263 resistance, it's that support. But if that support breaks, there's just not a whole lot more. I mean, this is your all-time low right there. But again, I think that'll be taken out, especially if Bitcoin has a lot more downside coming. That's it, guys. I said if I had time, I'll get to GDX. GDX, no change. Still, that divergence is still in place. Remember, we hit the pretty much the second target here on that daily chart. T3 was a support level plus the uptrend line. The uptrend line's now going to come in first. Big negative divergence, just like silver. Big negative divergence on silver. You can see here it's going up, no sell signals. The best you could do is maybe put an uptrend line, a little wedge like that. It could burn through the divergence. It all depends on its big brother gold and what the US dollar does. And because today was Fed day, I'll wait and see, let the dust settle. The dollar is back to my first target here. That's after that, coming off the bottom of that big trading range breakout there, hit T1, hit it again, broke out, got very close to T2, about 2/3 of the way or better, 3/4 of the way there. Put in a divergent high. It's corrected back, but it's back to that key support, $28. Again, this is UUP, the dollar index ETF. If it holds this support, which is also the 200-day moving average exponential, and goes up here, in my opinion, that will be the catalyst to send gold, silver, and GDX down, because that'll be a rising dollar, and those are net. That's a net bullish thing. And so on gold itself, this is the most important one. If you're going to trade silver and GDX, you want to watch this. There's that uptrend line. Gold, so far has peaked here. It's been moving sideways for months now, and you're riding this uptrend line right there. So replicate that. A solid break below that trend line is probably going to take us back down to that 361.28 level again. Remember, we shorted gold here right off the highs right there, and gold and silver and GDX. We hit my first, second, third, and pretty much fourth target, put in a divergent low, which has given us this move up. And now you have, as I'm drawing it out here for you, negative divergence once again. That was one of, not the only, but one of the reasons for shorting it here was that divergent high that we had. And again, it's this divergent low that was a catalyst for this bounce. And so there's that same trend line right here I just gave you on the daily chart. So if you don't already have it, you might want to set an alert. And if you have a lot of miners and metals and silver long right now, you might want to consider tightening up stops. If your stomach was sinking when this was happening. And again, silver and GDX are the ones that fall more when gold goes down. When silver broke that comparable wedge, it dropped in just a matter of a week or so, a little less than 2 weeks, 16%. So, and you can see here on the 60-minute chart, we've come full circle, guys. And another little bearish rising wedge with a divergent high. Wash, rinse, repeat. There's your trend line. All right, I'm going to wrap it up here, get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.